Here's something you might like: how to use your tax bracket sweet spot to divorce the IRS. Amicably, of course. We certainly don't like being partners with them when they get to decide how much of our money they get to keep and how much we get left. So let's take a look here. Former U.S. Comptroller General David M. Walker is traveling America for PricewaterhouseCoopers, basically telling everybody that they need to be aware that our government is run amok with spending, and tax rates are probably going to have to double within the next 10 years to deal with our unruly debt. Our debt is higher than it was in 1945 at the end of World War II, which was the first time it ever exceeded 100% of gross domestic product. Now it's over 130% of GDP, which is even higher than back then. And most economists recommend between 40 and 70% of GDP should be the target. So let's say you already believe that tax rates are going to be higher, maybe even double where they are today, when you go to take money out of your retirement nest egg. So you've decided you're going to convert $100,000 of your IRA to a Roth. What is that going to look like if you pay the taxes now instead of paying them later? The first thing you want to do is figure out your marginal tax bracket. And the way that we do that is we look at our tax return. Here's one from 2022. Line 15, the last line on the bottom, says taxable income. So that's your starting point. You'll want to adjust that for anything you know is going to be happening this year, whether it's going to be higher or lower, or just use the same amount. And let's figure out what converting $100,000 on top of that would do. Next thing you'd want is a chart for the tax rates. Here's 2023, and you can see rates for single taxpayers. There's a column there for married filing jointly, married filing separately, and head of household. The tax rates begin at just 10% on the first so many dollars. The next dollars are taxed at 12, and then they jump to 22%, quite a significant increase, and then just a 2% change to 24. And that's where we consider the sweet spot. We'll get back to that. For 24, they jump all the way to 32 and then 35 and 37. Everybody thinks those are high rates, but back between 1945 and 1985, those weren't very high at all. Tax rates went up into the 60s, 70s, even to the 90s on high earners. So we want to convert $100,000. Let's say your taxable income before the Roth conversion was $150,000. So you'd be in this 22% tax bracket if you're married filing jointly. It's the one we've highlighted there. So at $150,000 of taxable income before the conversion, we can see that if we converted $100,000, the first $40,750 would be taxed at 22%, and the rest, about $60,000, would be taxed at 24%. So you're looking at about a 23% federal tax on your conversion, plus whatever your state rate is. The last thing we need to do is figure out where the money's going to come from, what we can do to move money into a tax advantage situation most efficiently. We like to put our assets into three different buckets, if you will: taxable, tax-deferred, and tax-free or tax-advantaged. This is a spreadsheet that we offer for $19.99 on our website so that you can easily get started looking at your own situation by using it if you want. The taxable investments are the ones that give you 1099s every year. They're not sheltered from taxes pretty much in any way. They may qualify for capital gains taxation, but that's still tax. Tax deferred are ones that you put in pre-tax into retirement accounts and IRAs, where you get a tax deduction or a reduction in your W-2 as you're funding them. Often employer matches go in to that bucket as well, although with recent changes, employer matches could go into Roth accounts. The tax advantage is where you want all of your assets, or as many as you can possibly. At the bottom, we've added relevant notes for your benefit to look at items or consider items that would come into play as you move forward and try to move as many of your assets as possible from taxable and tax deferred into tax advantaged. So this is what we'd want to do. Consider your taxable, tax deferred assets and how you could get them into the tax advantage or tax free bucket, including Roth IRAs, HSAs, insurance cash values, and so forth. And at the same time, most efficiently pay the taxes. Taxes can be paid out of taxable buckets or tax deferred buckets or assets. You don't want to pay any taxes now out of your tax-free advantaged accounts or Roth IRAs and so forth, because that's the goal, is to get as much in there as possible. So it's pretty much a two-step process where you figure out your marginal tax bracket and how much can be converted without moving up to the 32% bracket or wherever you're not comfortable anymore. And secondly, identify where your money is and how most efficiently you could move it into tax advantaged. I hope this is helpful to determine how to figure out your tax bracket and use it to divorce the IRS, amicably, of course. And if you want additional resources or action steps you can take, you can order the 3 buckets pro forma sheet. The template is available at taxfreetutors.com. We also offer a course on Udemy, secret tax saving ideas your advisors aren't showing you, where we'll get into case studies and so forth and dig a lot deeper into all of these ideas. We encourage you to follow the national experts on debt and taxes, Ed Slott, David Walker, Maya McGinnis, David McKnight, among others. Ask your tax professional to consider this presentation and our course and see what makes sense for you. And reach out to me to help you find a tax-free tutor near you if you need some help. Thanks for your time.